What's up, apes? Welcome back to the Daily Peel's daily podcast / video stream of the day. Everybody make sure to go take the daily poll in our daily peel, and in the meantime, make sure you're getting in your daily protein. Thank you guys for joining us once again. I know it has been a while since we had the daily peel video stream / podcast of the day. We had a couple interims there. I was out fucking around in Zion National Park for a couple of days, and then over the past week, literally the busiest news week of the entire year so far, I was dumb enough to be busy closing on a house, so I wasn't able to be here talking to you guys every day. Wasn't at my usual workstation. I relocated from the Daily Peel Global headquarters for a couple of days there to the new or future Daily Peel Global headquarters. So we'll have an all-new setup in about a month or so, maybe a little bit less. We'll see on exactly how the timing goes for the move-in. But nonetheless, we have a whole lot to talk about. Some of the worst days for the market this year, in a couple of years, over the past week or so. Guys, first and foremost, let me just say, this is completely normal. To have a 2% correction, 2 or 3% correction is completely normal. What was weird was that we had made it into, just about August of 2024 without having a 2 or 3% daily pullback. That is extremely anomalous from a historical perspective. So what we're actually experiencing over the past couple of days is more of a normalization for the year. So if anything, it kind of makes me feel a little bit better, but we'll talk about exactly why in the ensuing minutes that I'm yapping with you guys on here. We got a big one for you today. So July's jobs report, that shit was an absolute disaster, and that is just the starting point. From a weakening labor market in terms of job creation, lower job growth, falling yields. We're going to talk about all of that. And then we're going to get into some of the biggest stock movers of the session as well. DoorDash absolutely crushed it on earnings, while Trump Media and Technology Group, the most innovative company of the century so far, came out with yet another innovation. I don't know how they keep doing it, but you guys are going to have your minds absolutely blown out of the water. We also saw an absolute humiliating day from Snapchat and Intel. It was completely disgusting, both of those earnings related, and we'll get into that as well. And then, of course, we'll be diving deep into the biggest earnings report that we haven't talked about just yet, the world's 6th most valuable company, and that, of course, is Amazon. Stick with us to the end to make sure that you're hearing all of that stuff, but let's go over some of the banana bits, some of the headlining stuff that we haven't had a chance to write about just yet. First and foremost, Berkshire Hathaway, they just dropped their earnings report. They are way too cool to report during the week, so Warren Buffett swings his big dick and reports his earnings on Saturdays. So I don't know why nobody else really does this, because it gives the market more time to digest the information that you're presenting to them without immediately freaking out in the after hours, the pre-market session, or most of all during the day. So they just dropped, they are absolutely slashing their equity portfolio. They sold more than half their position in Apple and currently have a record-breaking $277 billion in cash sitting on their balance sheet. That's more than most central banks have. That's more than the current U.S. Treasury holdings that the Federal Reserve has at about $178 billion. So completely ridiculous numbers coming out of Berkshire Hathaway in terms of their cash balance. We'll see what they're going to end up doing with that. I mean, they could literally go and buy like 2 Goldman Sachs right now if they wanted to. So we'll see if they take their offer up on that. But what also happened at the same time is that mortgage rates just plunged to a 15-month low. Boomer homeowners are finally selling their houses, getting the fuck out of our way. And at the same time, we did see rates completely collapse, kind of market-determined rates collapsed in the face of that jobs report, so expect them to be moving lower going forward. Obviously, they had to wait until I bought my house before conditions in the market became more favorable to buyers, so you're welcome on that. That's Murphy's Law in action right there. Check out this full breakdown from the Wall Street Journal on Apple's artificial intelligence integration. Yes, AI stands for both Apple Intelligence and artificial intelligence when we're talking about the king of Cupertino. They're going to be having a bunch of new innovations by the end of this year. They're pretty much only going to be available on iPhone 15s and later. I am talking to you on my iPhone 14 Pro, which I've had for almost 2 years now. I'm not a big upgrade every year cycle kind of guy, but I might do it this year just to get those AI integrations. Plus my charger point is kind of all fucked up. I think there's sand in there. It's tough to keep it on there, especially for CarPlay. Moving right along, Latin American Amazon, basically the Latin American version of Amazon. It's called Mercado Libre. Smoked it on earnings. The stock was up more than 13% for the session. They had a great day. Meanwhile, Chapter 11 bankruptcy. This is the good kind of bankruptcy that's more restructuring based rather than liquidation based like Chapter 7. Just hit a new high for the decade. So anybody working over at Green Hill, any of these restructuring desks, you guys are going to be busy for a long time. Finally, a much-needed sanity check after the recent market sell-off comes from our boy Ben Carlson at A Wealth of Common Sense. go ahead and check out all of that stuff, because that's what I'm talking about at the beginning here, where in saying that a 2 or 3% daily pullback is a normalization. It's not, the end of the world. We'll talk about what's the end of the world in a second, because there is that. But it's not just because the market is pulling back. So go ahead and check that out if you need a little bit of a dose of sanity. It's kind of like taking Narcan. After you're hopped up on all this equities bullshit, it calms you down a good bit, slows the heart rate, and hopefully keeps you alive in the meantime. Daily poll, will U.S. unemployment hit 5% or more by the end of this year? What do you guys think? I'm not going to be giving out my answers here. Oh, I should actually go over the last poll. That would be a good idea to do in this. Let me go ahead and get that pulled up. Give me 1 second, everybody, because the last poll that we had was related to interest rates and how many cuts there would be this year. So let's go ahead and see what you guys had to say. It looks like we are definitely sure that there's going to be quite a few rate cuts, and it seems like the majority, or the biggest percentage, was 40.1% for 2 rate cuts by the end of the year, 39.1% for 1, 8.4% for 0. Who the fuck are those 8.4%? Are you paying attention? Then we have 7% for 3. Now, this is talking about the equivalent of 25 basis points. So if you said 3, that could entail 150 basis point cut and 125 basis point cut. So just so we all know the rules after we already played the game, want to make sure that we go over that. So it looks like there's going to be 50 basis points of cutting in 2024, according to our very wise apes here at the Daily Peel. Personally, I would say that there's going to be 3 equivalents of 50 basis point cuts, or 25 basis points, excuse me. We'll get into why right now. The canaries are leaving the coal mine. This is our major macro story of the day. Canaries are getting the hell out of the coal mine already. It's really difficult to find a likable nerd that can be your Federal Reserve chairman. Luckily, Jerome Powell is definitely likable and nerdy, but the other big thing is that you want them to be a good vibrator, kind of like a bottle girl at a Miami nightclub or something like that. You want them to be good at reading the vibes. And J-Pow absolutely is not. My dog woke me up at 5 a.m. this morning, and J-Pow has done less well of a job at reading vibes than my fucking dog did this morning. Fucking making me take him outside and shit. But whatever. None of that really matters. What does matter is that the Fed might have become a little bit too data dependent. So let's go ahead and break down the employment situation summary from Friday. This is the July jobs report, and these are the numbers that we were given. So what you're seeing right here is a dramatic slowdown in hiring in the United States. Now, this is something that's been in play for quite a while, but the drop off last month was very significant. So we added about 114,000 jobs to the July payroll. Now that's definitely going to get revised lower, as pretty much every month in the past couple of months has been revised lower on that next report. And that's exactly what we saw in July. So 114,000, it was well below economist estimates. And at the same time, we saw unemployment continue to creep up to 4.3%. Yes, this is the rate of unemployment increasing over time, and we just hit a new high since April of 2021. First time in 3 years that we've been at 4.3%, and that was still during the COVID recovery. So, it's not looking good out there. But the thing is, to say that it's not looking good isn't necessarily correct. What the correct thing to say would be the labor market is not as on fire as it was over the past couple of months. 4.3% is still a historically low unemployment rate. We're still adding a bunch of jobs. The U.S. economy and the labor market is doing just fine. But what it is doing is getting worse. Now, we always talk about it's not good or bad, it's better or worse. And that's why the market is throwing the fuck up right now, because we're coming out of a Goldilocks economic situation. So pretty much any changes are going to make things seem worse than they actually are. But what we're seeing right now as it relates to the Federal Reserve's interest rate cut have become quite clear. So one of the biggest takeaways from this report, especially as it relates to interest rates through the inflationary channel, is wage growth. Average hourly wage growth for the U.S. worker, consumer workers, as we all operate in this capitalist environment. Capitalism is great, by the way. But nonetheless, we consumer workers did see some of the lowest growth in our wages over the past during the past month. It was some of the lowest that we've seen in quite a while. I believe it was going back to a 3-year low as well, back to about April of 2021 there too. Yeah, that's basically when you see it in this chart right here, because this is the Fred chart showing average hourly earnings, or the growth rate, the year-over-year growth rate. We are currently sitting at 3.6%. We just fell below 4% for the first time since June of 2021. So, a good anniversary for us that our wages are slowing down dramatically. But what this does mean is that the inflationary pressures are no longer there from the labor market side, or at least they are much less so. Now, it's great to see that wage growth is still outpacing inflation. This is nominal wage growth, by the way, which is sitting at 3.6%. So if we adjust that against CPI, we're still getting, less than 1% real wage growth, but still it is wage growth nonetheless. And we can definitely be happy about that. Okay, so summary so far. We're seeing a slowdown in total hiring. We're seeing unemployment tick higher and we're seeing wage growth go lower. So what does that mean? The Fed is doing its job. This is exactly what the Federal Reserve has set out to do, and they are doing a bang-up job of it. Now, the question is, did they do it accidentally? Did they get lucky? Because things seem to just be falling in perfect place, and the market is certainly responding to it. So that's what we're seeing in this chart right here. This is one of my favorite charts in the entire world from the CME Group, and it is doing the dollar-weighted market implied odds of the next Fed move at its subsequent meeting. So they go up basically to the end of the calendar year, and they project exactly what the market is thinking interest rates are going to look like at that certain meeting date, or by the end of that certain meeting. This is looking at September, and there's currently an 80% odds for interest rates to be in the range of 4.75% to 5%. Right now, they are currently at 5.25 to 5.5%. So clearly, the market is pricing in for a 50 basis point cut in September. Now, at 80% odds, if this meeting was to happen tomorrow and the Federal Reserve only cut by 25 basis points, that would be quite a disappointment. It would be quite the shock to markets. But the odds always kind of get much more volatile, get a little bit more extreme in the immediate aftermath of the report. So expect this to trickle lower. It might even out a little bit as we approach that date. But what is a clear sign that interest rates are moving lower is the movement of the yield curve. So that's what we're seeing right here. This is the monthly yield curve on a 2-month basis throughout 2024 so far. So we're starting in February, then we're getting into April, June, and August. So this is going by the second date of each month. What we're seeing in this dark blue line right here is the August 2nd yield curve, the Treasury yield curve of the United States. What do we notice right here? It's becoming more and more of that cup and handle, kind of like Big Dipper type of thing. And so it's a very interesting pattern right here because we have been talking recently about a bear steepener, but that's clearly, not necessarily what's happening right now, especially with the dynamic between intermediate term rates as well as longer term rates and shorter term rates. They're kind of not painting a clear scenario whatsoever right now. Seeing this cup and handle, especially for as long as we have been seeing that shape of the yield curve, is very unusual for the United States. But one thing is clear. The clear takeaway from this chart is that interest rates are moving lower and the market is starting to price for it. So in summary, the canaries have already left the coal mine. In finance, we like to use these analogies to make it seem like what we're talking about actually makes sense or has some value in the material, physical, tangible world. Most of the time, it absolutely does not. So we use analogies like canaries in the coal mine. What does that mean? Back in the day of, that coal miners were fucking running the show in England, some things that they used to do to test out the carbon monoxide levels of the mine itself would be to bring in some canaries. And if the canaries flew the fuck out of there, carbon monoxide is too high. It's not safe to go in there. So people like to say that, the canaries in the coal mine are heading out. It's kind of like a warning sign for things in finance. Let me tell you, the canaries are gone. The warning signs are here, and it's not necessarily warning signs that are saying like the economy is about to fall apart, the coal mine is about to cave in, but it's just saying this is becoming a little bit of a problem and we need to do something about it. It's about time the Federal Reserve cut rates. They're already late to the game, if you ask me, and if you ask the market as well. Pretty much everybody is saying that, and that is the problem of being too data dependent. J-Powell was waiting until the numbers actually printed saying what he needed them to say in order to cut rates, when it was pretty clear going back to, March, April, that unemployment was trending higher, wage growth was trending lower. We probably could have started cutting back in the June, definitely in the July meeting. I'm kind of surprised that they didn't last meeting, but the Powell Fed likes to use a setup meeting before they make any moves. Like we've talked about before, this guy is a man of conviction. He's not going to do anything until he's sure, but then when he is sure, he is going to do it harder than any Federal Reserve chair has ever done in the past. And maybe I'm not even just talking about interest rate movements right there. Wink, wink, if you know what I mean. That's a great way to end it. So let's go ahead and move on into some of our big stock movers of the day. We've DoorDash up 8.4% for the session because the bull market and laziness is still as ripe as it ever was. Getting poor people to deliver us food is a great American tradition over the past couple of years, and DoorDash is absolutely still thriving because of it. The company reported a loss of 38 cents per share on $2.63 billion in revenue for the second quarter. Now, the market was expecting 9 cents per share in losses, but it seems like these aren't immediately comparable based on operating expenses that the market hadn't necessarily planned for. They thought that they might be capitalized or, whatever the discrepancy was right there. But either way, it was a very solid quarter. They saw sales grow 23% year over year. Total orders grew 19%. So they're improving monetization as well because revenue is increasing faster than orders, meaning they're doing a good job of gouging us on inflation. Guidance came in higher than expected. It's all good in the DoorDash delivery market. Moving on down into our absolute favorite stock in the entire world, Trump Media and Technology Group, DJT. I know what you guys have all been thinking because I've been thinking it over the past years since 2016, basically. I wish there was more news on Donald Trump and American politics in general. I certainly do not get enough of it, and thankfully, one market participant is coming in to fill that demand. So, Trump Media and Technology Group, the latest globe-changing innovation, they came out here and announced that they are going to be starting a streaming network for what they call neglected news, even though this seems like this is the same bullshit that we talk about nonstop on literally every single TV network. Every social media account that you see is plagued in this stuff, but fuck it, let's throw another one out there because why the hell not, I guess. Now, what they did say that makes this network special is that it's going to be uncancelable. You absolutely cannot cancel this streaming network, and I can only assume that they're talking about subscriptions and you're not able to cancel those because I don't know how else they're going to make any fucking money off of this thing. But nonetheless, the stock was up 7.4% on the session because the crazy fucking fanatics who buy this shit like it, apparently. Moving on down into Snap. This stock, Jesus Christ, the Snap earnings report is just becoming a quarterly public humiliation event. It's like when they made Cersei strip naked and walk through the streets in Game of Thrones in season 5 or 6, whenever that happened. Spoiler alert if you're just watching the show, by the way. But that's actually kind of fucked if you are just watching the show. Pretend I didn't say that. You didn't hear any of that. But as much as there is a bull market in laziness, there's apparently a bear market in nudes because Snapchat cannot command any pricing power on its ad-based platform whatsoever. They're also not seeing super strong numbers in daily active users, but we'll talk about that in a quick second. It is difficult. Snapchat's in a tough position for a social media firm because it's not like they're only competing with, like, if you look at an Instagram, they're competing basically with like TikTok and Twitter. It's like, what are you going to scroll through and waste time on? Whereas if you're talking about Snapchat, you're also competing with things like iMessage because you're communicating with your friends on that. Now, I know that Facebook has, Messenger and they have WhatsApp and shit like that, but those are all like separately divided apps for those certain purposes. Snapchat is all in one platform. So not only are they competing with the TikToks and Instagrams of the world, they're also competing with the WhatsApps, the iMessages, the OnlyFanses of the world, like all of that stuff. Snap is taking on all of them. And it definitely shows in their earnings report. So they missed by a ton. Year-over-year revenue growth wasn't enough to beat estimates at 16%. They missed on the bottom line as well. They saw 432 million daily active users, which beat the 431 million that was expected, but with an average revenue per user of $2.86 against the $2.91 that was expected. The market sold off because they are not effective at monetization whatsoever. This has really been Snap's problem since they came public. Twitter faced a very similar problem, just getting that monetization up. Dude, Facebook has monetization per user of like $50, $50, and Snapchat's at $2.86. Just absolutely disgusting. I think anybody that clicks on an ad on Snapchat, it's accidental, probably 99% of the time. Also, speaking of accidental, was Intel's 26.1% plummet. Absolutely disgusting. The company is in shambles. The stock is in shambles. I talked to a couple employees this week. They're thinking about just drifting out to sea and giving up all hope. Meanwhile, NVIDIA's biggest problem is that they're losing employees because they're minting literal deca-millionaires by the day. And so obviously, why would you keep working if you have $25 million in your company stock? Either way, Intel down 26.1% on disgusting, terrible, gross earnings. They reported $2 cents per share, on $12.83 billion in sales. That's a 1% year-over-year decline in sales, and it actually missed estimates by a shit ton. So that $12.83 billion in sales missed the estimate for $12.94 billion. But on the bottom line, keep in mind they reported 2 cents per share. The market was expecting 10 cents per share. So they missed that by about 5-fold. And on a GAAP basis, Intel actually lost $1.61 billion in the quarter. That's a huge swing from the second quarter of 2023, in which they made like $1.4 billion. Absolutely disgusting. A big reason for this is because the company is going through a restructuring that the market fucking hates, apparently based on this reaction. Basically, they said that they're kind of reorganizing so that they can put their AI chips to the forefront, but it's clearly not working out for them right now. We'll see if they can make a better pivot for the next quarter. Okay, so let's go ahead and move on into another absolute disappointment of the day. Yes, this one is earnings-based, and we are talking about the 6th largest company in the world, everybody's favorite place to go on Black Friday, Prime Day, literally to shop for anything whatsoever, and that is Amazon. This company was started as the business that would sell literally everything, and you would think that that would basically have a nonstop growth trajectory, and they basically have in terms of their fundamentals, but the stock price absolutely did not. The stock ended the Friday session down, I didn't write it down yet, 8.78%, so roughly 8.8% in response to those earnings. Let's go ahead and find out why they were so bad. God damn it, I keep forgetting to fucking change this chart. Not that I had any for the stocks, but I want this in the background when I'm talking about the stocks. So let's go ahead and talk about Amazon. So the world's sixth most valuable company, like I've said a couple of times now, they delivered $13.5 billion in sales for the second quarter. That was net income. Excuse me. I'm used to that being a sales figure. They delivered $13.5 billion in net income for the quarter. Enormous. That's $1.26 per share. That's 101% growth compared to last year. Sales grew 11% to $148 billion. And based on the looks of this chart, you might think that that would be pretty good, but it actually missed estimates. Mr. Market was looking for closer to $148.5 billion. And we all know that that $500 million is so important when you're talking about literal central bank balance sheet size of revenue. But nonetheless, this is what the sales trajectory had looked like so far. The North American proportion continued to shrink. That was actually one of the more disappointing sides of the quarter. There's basically two segments of revenue that were disappointing. It was North American e-commerce, and it was also Amazon's advertising group. So just like Snapchat sold off, just like Pinterest sold off in response to their earnings, Amazon's media team was not looking good. Now, Amazon Media Group has been one of the fastest growing ad networks in the United States, in the world really, for the past couple of years, because they just kind of burst onto the scene. They realized that their own kind of internal website search engine is just as valuable as Google, essentially, or at least just as valuable as YouTube. So they really started to lean into that, but it did not work out well for the quarter. Now, but what they did see was solid performance in AWS. Now, Amazon Web Services, this is their cloud unit. This is the most important division of the company. It's the same thing as Azure and Google Cloud Protocol, or whatever the fuck it's called, GCP over at Google. It's basically the same thing. Sales grew 19%. They hit $26.3 billion. That actually did beat the $26 billion estimate. This is where we can see the trajectory of AWS's net sales as well as its operating income, all moving up and to the right. So they're looking very strong in the most important segment, but AWS is also a little bit more mature than Azure, than GCP, than Oracle's cloud network, and a lot of these other hyperscalers or wannabe hyperscalers, really. So a little bit less is expected of them. So that's why AWS beat, while Azure beat, but slightly. GCP was a little bit rocky on those numbers, but nonetheless, it was very strong for Amazon. Now, the weak part, again, the advertising side, we can kind of excuse that. That goes along with the global macro environment. But what we absolutely cannot excuse is the slowdown in North American e-commerce. This did come in a little bit lower than expected. The company partially blamed this on, just consumer dynamics. So we'll basically get a test to see if that's actually true when these other mega retailers report. We got Walmart and we got Target on August 13th and 14th, I believe. It might be the 14th and 15th. But really, I think one of the biggest problems going on here is that Temu and Shein are biting into Amazon's margin, and especially their top line growth. Temu and Shein, they rely on child labor for the most part, because I don't know how the fuck else you're selling Jordans for $25 a pop. I don't know what the hell they're doing over there, but they are absolutely killing it. And they're taking a lot of attention away from the big dog in Amazon. So that's basically the story of Amazon's earnings. It was a rough look. Now, they did solid overall. Don't get me wrong, but they did miss the market's expectation. And I think this is actually the biggest takeaway of the report. All the numbers were solid. They missed on revenue by a slight teensy little bit. Now, it's really not a big deal at the level that Amazon is at, being at $148 billion in revenue versus $148.5 billion. Really shouldn't be much of a big deal, but it's a huge deal when you're trading at the valuations that these tech stocks are. When you get up to those very brittle valuations, when your valuation is as much in the clouds as your business is, you got to live up to that valuation. And so any disappointment is going to bring a very rocky return. And that's exactly what we saw. We'll be looking out for other mega retailers. And most importantly, our question of the day: are you buying this dip? Are you buying the Amazon dip going forward? Like I said, down 8.8% on the session. Morgan Stanley just named them their top pick for the rest of 2024. So you tell me, are you buying the dip? Let us know in your responses below. Do have a quote from Mr. Jeff Bezos to finish us up for the day here. He said, "The framework I found, which made the decision incredibly easy, was what I called, and only a nerd would call, a regret minimization framework." So in that, he's describing his decision to start Amazon because he said he would basically regret starting a business and having it fail than never starting a business and not knowing what would happen. So take the inspiration from Jeff Bezos that you need on this beautiful Monday morning. It is 7:16 p.m. I'm going to go eat dinner on this beautiful Sunday, August 4th, 2024. Pleasure to be back with you guys. I will be seeing you all week. We're back to our usual programming. Like I said, I'll keep you updated with the home purchase, and I'm going to have plenty of news on that. I'm thinking of interviewing myself in a couple of weeks, whether I do that in a written edition or in a video format, or maybe both of them, just to look like even more of a crackhead than I already do. I think that would be an interesting way to play it. But nonetheless, thank you guys for joining us. I hope you're pleased with the long one for the session here today, because I've been gone for so long and I've really missed you guys. So I'm glad that you're still here with us. And nonetheless, I'll be seeing you tomorrow. Happy investing, happy trading, stay safe, and we'll see you then. Bye now.